So for my next question, boss, so we had a client get nervous about IRS letters, so he wanted to ask, what is this scariest IRS letter that's actually not a big deal and the quietest one that's a real problem?
Hmm. It's a good question. So the one that what that people freak out about is corporate late filing penalties. So people have tax due dates. April 15th. Corporations have tax due dates. If it's a pass through, it's a month before the it's a month before the individual due dates. So March 15th regular. If you do 6 month extension, it's September 15th. That's a month before the individual and C corporation deadlines of April 15th. An extension goes to October 15th. So it's a month before because you need those documents in order to complete your individual tax. So what happens a lot of times is the IRS has their classifications all screwed up. So there have been times when, like, let's say there's an S corporation. We filed as an S corporation last year, accepted, no problem. Files it as an S corporation again, accepted, no problem. The third time, files an S corporation, rejected. This is the wrong type of corporation. That's like the error message from the IRS. And we're like, the hell are you talking about? We didn't change anything. You've been accepting it. And so, um, and so then you file it, manually. And then by the time they process it, it's late and they send out this letter. Uh, so the letter, one of the forms, there's a couple different versions of the letter. One of them says notice of intent to levy, and they'll just say like, $1,200 or something like that. Depends on how many people and how many months and all this stuff. Um, and people forget about that because they think, oh no, the IRS is going to take my house. Well, don't freak out. Number one, it's not to you; it's to this corporation. It's a different tax entity. That's kind of the whole point. So if that entity has a bank account with millions of dollars in it, then okay, that might be a concern. Obviously, if something were that kind of issue that had to be paid, then just pay it, right? Um, but you know, but it's not you that aren't going to take your house or anything like that. The one exception to that is, well, this isn't a late filing penalty, but if you mess with your trust accounts with payroll, they don't like that. They will come after you personally. But for just late filing of tax returns and stuff, it's just to the company. And as long as you didn't break the company by piercing the corporate veil and doing things you're not supposed to do, then you're fine. Um, and then typically we can almost always get rid of those penalties anyways, because it's either their screw up with this, like electronic matching system that they have, or just as one of the things that we do here at Tech Sherpa is to preemptively file um, extensions. So we will try to file electronically first. A lot of times those don't work, and we will file by mail under multiple code types just to make sure that it gets through the system. And but anytime we mail something to the IRS, a lot of times they lose stuff. It doesn't get recorded correctly. It's a madhouse over there. But keep our receipts and all this kind of stuff. It says, well, you accepted it on this date with this tracking number, and it eventually goes home. That's the vast majority of the time. So that's one that people freak out about and shouldn't. And one that they don't freak out about and should is, well, so what happens is, I don't know if it's don't freak out and should, but don't do anything and should. So 70% of the letters that the IRS send get no response at all. And people just, throw up their hands or put their head in the sand or whatever analogy you want to use. And they just take it. Right. And the vast majority of those cases are low income people who get challenged on earned income credits and child tax credits. So there's two different forms that those take. So, the earned income credit and the child tax credit are money that are given to taxpayers who have earned income of various kinds. Could be self-employment, could be W-2, and have children in the appropriate ranges. So they got to be, like for child tax credit, it's birth through 16. For earned income credit, it's birth through 17, but it can go longer if they're in school. And the IRS pushes back a lot on these credits because they are the largest outflows from the IRS. And so, many years ago, probably like 8 years ago at this point, um, the congressional committee hauled the IRS commissioner in front of them and said, "Hey, why are you auditing these people? These are poor people. Why don't you go after rich people?" And the IRS commissioner at the time, he said, "Well, basically, it's easier." It's kind of the summation of what his testimony was. And we went on to explain that, well, rich people, one, they have, professional help that, are very good at rebutting audits. Two, on the IRS side, it requires a higher level of expertise. Uh, and it's harder to keep that employee at the IRS because they know they can go out into private industry and make more money. And you'll see a lot of guys on, LinkedIn or whatever, and he'll say, former IRS auditor, whatever. And gives them that cachet of, it's like, well, I was on the inside, now I'm on your side, right? So I know this and that, which is sometimes true. As people develop those expertise, they then leave the IRS and they're harder to keep on staff. They're more expensive to train, more expensive to keep, and all this kind of stuff. And so as a result, they audit poorer people who get these tax credits. And, those IRS employees are easier to train because it's a lower level of sophistication. And the people who receive those letters don't fight back fundamentally. So those people should fight back, because again, there's two different challenges that the IRS comes up with when it comes to challenging these tax credits. So number one is, are these your children? I had one client many years ago who, we sent in all kinds of proof, like birth certificates, whatever, and they just deny. And so he actually ended up going into the local field office with his children and said, "These are my children."
That's funny.
And finally they dropped it basically. So if you weren't necessarily married when you had a child and somebody has a different name, then say, okay, maybe there's some questionability there. But typically you got to prove that they're related to you. That's going to be generally through a birth certificate, and you got to prove that they live with you, and that's going to be through like a lease or a utility bill or school records or something listing your address and their name. And then that's going to match your tax return with your name and your address. So that's typically how you prove that it's your qualifying child. Right? So that's the first avenue of attack. The second avenue of attack is like, did you have the earned income in order to justify this thing? And this happens a lot with self-employed people. So if you don't keep good records and you make cash, let's say you're a cleaner, you're a house cleaner, and you have your customers and you make $30,000, and have cash, a check, and have somebody deposits to Zelle or something like that. You can have a lot of trouble proving that you have that income that justifies you in order to take the tax credit. And so, it comes down to record keeping. The vast majority of what IRS gets people on in audits is record keeping, because people don't keep records or don't keep good records. And so, that's far and away the number one cause of people losing those kind of challenges from the IRS. But yeah, so those people who get those letters, don't freak out enough, because we know that they're not responding. So yeah, I mean, if you're entitled to that tax credit, you should absolutely claim it and keep it and defend it. So that's number two.
And
This is actually one of the things that's in the bill right now for Congress. So Section 179 is to allow for complete, or not necessarily complete, but faster write-off than normal depreciation. So you buy a business asset, like let's say furniture. Furniture, depending on the type and whether it's office or whatever, can be like a 5 or a 7 year depreciation schedule. Now, bonus depreciation is a separate beast. We'll come back to that in a second. But let's say you buy some office furniture. It's a whole suite of stuff. It's $7,000. Now, normally, under normal depreciation rules, you would get $1,000 a year of write-off for that $7,000 purchase, because that's considered the the useful lifetime of that asset. So it's more than 1 year. So you got to write it off, matching that useful lifetime. And so you say, it's like, well, I have income and I'd rather write it off sooner than that. So then you use section 179 and you can write off, you can write off the full amount or up to the amount of profit you have, whichever of those is less. So if it's a $7,000 thing and I make, net profit after everything, I make $100,000, then I can take that $7,000 deduction. That's going to reduce me down to 93. Okay. So that's scenario number one. Scenario number two is I've got $5,000 of net profit after everything is said and done because, just that's the kind of year it was. And so I can only deduct $5,000 of that seven under section 179 and the rest will roll over. And you can potentially do 179 later on the remainder, but depends on that later. So that's how section 179 works. There are limits and there are, special rules for certain kinds of assets and all that kind of stuff, but that's the general idea. So, bonus depreciation is better, typically because bonus depreciation does not have the limitation of profitability. So if I have $5,000 of net profit and I've got the $7,000 asset, if I'm able to take bonus depreciation of 100%, then I could go from 5 to -2, which is in most cases better than just going to 0. But the rules for bonus depreciation come and go. So 2011, we got unlimited bonus depreciation, and that was great. And then 2017 rolls around, we get Tax Cut and Jobs Act that brought back 100% bonus depreciation. But then it's starting to expire, and it's in its wind down phase right now because of everything from Tax Cut and Jobs Act is expiring. So that's part of the big beautiful bill that's in Congress right now. They're wanting to bring back 100% bonus depreciation for the regular stuff, like fixtures and furniture and equipment and that kind of stuff, and making it permanent rather than just having this expiration period. And they want to create 100% bonus depreciation for factory construction, which, if you're in the manufacturing space is huge because, if you were to build a factory, typically that's a 39-year period. That's a non-commercial real estate. And if you can write off building the factory in the year that you build it, then that is an enormous incentive that you can take advantage of. So just, different things to be aware of as the rules change constantly. So, so that's a little bit about 179 versus bonus, and they are talking about adjusting the rules for the 179 as far as dollar limits and things with the big beautiful bill as well. But it's just not as relevant when you get bonus depreciation. So, and in certain circumstances, you can actually do both 179 and bonus, but that's fairly rare. All right. So that's all my 8 pence for 139.
Understood. Well,